So in today's video, I'm going to go over all of the out-of-pocket costs and expenses when it comes to buying a home. And if you're new to my channel, my name is Meredith. I'm a mortgage broker. I've helped hundreds finance real estate, and I put out educational videos every single week. So make sure you hit that subscribe button so you get notified. Now let's get into it. So in this first section, I'm going to go over what we call our fixed cost. Now, these are fixed costs because it doesn't matter what type of loan product that you're doing. If you're doing VA, USDA, FHA, conventional, these will always be there and will always be the same. And I broke it down into 4 in the order of which they will happen. Now let's go over the inspection. One of the first out-of-pocket expenses is going to be an inspection. An inspection, it's normally done once you've gone under contract within that first week. Normally it's done within the first couple of days. And what you're going to do is you're going to hire a licensed home inspector. They're going to come out to the house, take a look at everything. They're going to do a several-hour home inspection. Their main job is to, number one, identify any potential issues that are currently happening. And also they look at any issues that can happen later on down the road. Now, technically, it's not required per the contract for you to do a home inspection. However, it's highly recommended, especially if you're buying something new. Even if you're buying a new construction home, it's still highly recommended. This is also can be used and can help you when negotiating to the seller if there's anything wrong, if there's any damages that you're trying to negotiate. You can use that home inspection as proof. Now, this typically can cost anywhere from about $450 to about $600. And this will be upfront cost if you decide to terminate the contract, if you do not like it or you cannot come to terms with the seller, then that money that you put for the home inspection is gone. Okay, so next is going to be your earnest money deposit. Now, this deposit, think of it almost like a security deposit. It's really like a good faith deposit. And you will put that down within the first 3 business days of the contract. And that money will get either held with the title company or the real estate agents, their brokerage office. It doesn't go directly to the seller. And this depends on which state you're in. Also, typically, it's about 1% of the purchase price. So if you're buying a $200,000 home, then typically the earnest money deposit is going to be about $2,000. Again, that is not set in stone. You could put down on the contract $100, you could put $10,000. It's just something that you will work with your realtor when you submit that offer. And if you end up closing, this gets counted towards your down payment. So they will just subtract that amount from the down payment. Now, if you do not end up closing, let's say you end up canceling within that inspection period, or if you meet the other contingencies and you end up canceling, then you can get that money back. However, if you do not hold up your end of the contract or you don't meet the contingencies that you set in place, then the seller can actually hold that money. Now let's go over the appraisal amount. Okay, so the third expense is going to be an appraisal. An appraiser is required by all banks, and what they do is they want to make sure that you're not buying the home for less than what it's worth. So the bank is going to order an appraiser to actually go out to the property. They look at several things. They look at recent comps in the area that supports the sales price, but they also go beyond that. They do their own inspection on the home as well to make sure there's no major safety issues. And this is typically done on the second week after you've gone through inspections. Now, this is not set in stone. If you have a quick close date that you're trying to meet, you can do this in the beginning of the contract as well. You can push it out a little bit farther, but typically speaking, it's done on the second week. And it's normally completed. You'll get the report back. It takes at least a week to 10 days to get the report back because there's a lot of data that goes into it. And this normally costs anywhere between $500 to $750. Now let's go over your closing cost. A lot of buyers are unaware that closing costs even exist that are on top of the down payment. And what they are is just the cost of transferring ownership from the seller to the buyer. There's a lot that goes into it. There's lender fees, title fees, there's paying a portion of your property taxes, paying your home insurance up front for the full year. There's also government fees and state stamp tax fees. So there's a lot that goes into it. Typically, it's going to be about 3 to 4% of the purchase price. So if you're buying a home for $300,000, closing costs can be around $9,000. Now, this is just an estimate. This is a general rule of thumb. This is going to change from state to state. Some states have a little bit lower taxes, some states has higher. So when you go under contract, you're going to get an estimate from the lender and the title company so that you'll know up front. And these closing costs are due at closing. It's not going to be something that's going to be up front. And here's a pro tip. You can actually have your seller cover all of your closing costs. And this is something that you would want to negotiate with your realtor up front. Okay, so the next section is going to be the down payment. And the down payment really depends on the loan type that you're doing. There's really 4 major types of loans. So we're going to break down each of them and go over how much you need for each loan type. So with an FHA loan, it's a government loan and it can actually be used by everyone. It's not just for first-time home buyers. And the minimum down payment is going to be 3.5%. And they base this 3.5% off of the purchase price that you're buying. Now, what's good about an FHA loan, especially if you're a first-time home buyer, is you can also combine it. There's a lot of grant and down payment assistance programs out there that you can combine with an FHA loan that will cover that 3.5%, so you don't have to come out of pocket for a down payment. Now, FHA loans are generally speaking best for those with a lower credit score. So really for those with below a 680 credit score. Now, if you have a credit score that's below 620, you're most likely going to need a higher down payment. You're also going to get killed on the rate and the fees. So really that next benchmark for an FHA loan is going to be a 620. Now let's go over conventional loans. Okay, so a conventional loan is going to be best for those with a higher credit score, generally speaking about 680 plus. And if you're buying your primary residence, which means the house that you're going to live in, and if you're a first-time home buyer, minimum down payment is going to be 3%. If you're not considered a first-time home buyer, then minimum down payment is going to be 5%. And if you're looking to buy an investment property, minimum down payment is 20%. And if you're looking to buy a second home, then minimum down payment is going to be 10% of the purchase price. Now let's go over VA. Okay, so a VA loan is only for those that are either active military, a veteran, or a surviving spouse. And there is no down payment that's required on this loan. This also loan can only be used to buy your primary residence only, so you can't use it to buy an investment property or even a second home. Now let's go over USDA loans. So with the USDA loan, this can only be used to buy a home in rural areas only for your primary residence. And it's very restrictive on location. So just because the area you think is in the country or it might be far outside of the city limits, it might not be qualified for USDA. So you must know all the areas up front. And this is also always changing as well. Minimum credit score is going to be a 645. And there's also no down payment that's required on this loan. Now here's the total cost added up. So out of pocket, before you even reach to the closing table, if you're buying a house for about $200,000 FHA loan, you're going to need at least $3,000 up front. Then let's say the seller pays for all of your closing costs, and at the closing table, at that time, you'll only need an additional $5,000 because again, down payment's 3.5% of $200,000, which is $7,000. You already put $2,000 in escrow, so your cash to close would be $5,000. And if you like this video, then you're gonna love the video that I just posted on how all of the down payment assistant programs that are available, so you're buying a house with zero out-of-pocket expense.